Today, we want to take a look at a leading Insurtech company, SelectQuote. It seems that we may have missed the opportunity of a bargain when its share price plunged post the latest fourth quarter and the fiscal year 2021's earnings results publication. But I think it still presents an interesting opportunity currently despite the rebound in its share price. Let's understand the company's business and financial first so that if the share price reverses downwards again, you can have the opportunity to scoop up more of its shares. Understand that SelectQuote is an insurance distributor, so it does not insure end consumers or bear any underwriting risk per se. Its key business is in providing a technology-enabled direct-to-consumer distribution platform that provides consumers with a transparent and convenient venue to shop for complex senior health, life, and auto and home insurance policies. And these policies are curated from a panel of the nation's leading insurance carriers in the United States. In essence, consumers can research and compare various insurance policies across different verticals that suit their needs. In return, SelectQuote earns commissions for the policies it sells on behalf of the insurance carrier partners. In fact, the company was founded more than 35 years ago in the US, hence it has been building up both its proprietary technology and data points to fit on its platform algorithms to maximize marketing dollars efficiency, enhance agents' workflows, and better match various insurance products to end consumers. SelectQuote segregates its business into three key operating segments: senior, life, and auto and home insurance. The senior segment primarily sells senior Medicare-related health insurance, including its latest initiatives, Insight Response and Population Health. The life segment primarily sells term life insurance and final expense policies, and the auto and home segment primarily sells individual automobile and homeowners insurance. As you can observe from the latest fiscal year 2021's results, the senior segment is the key business and area of growth, contributing about 78% to the company's top line, followed by life and auto and home segments. So, as discussed earlier, SelectQuote's share price plunged post its latest fourth quarter and the full year 2021's earnings result that was announced towards the end of August 2021. This is due to the worse than expected fiscal fourth quarter results and disappointing guidance for the fiscal year 2022. Just a note, the company's fiscal year of 2021 ends on the 30th June 2021. While revenue for the fourth quarter grew 33% to $188 million from the same quarter last year, net income and adjusted EBITDA tanked more than 80% and 47% respectively. The lower net income and adjusted EBITDA were impacted by a few factors apart from agent productivity and efficiency of marketing. SelectQuote is still trying to grow its business aggressively by ramping up new agent hiring during the quarter, as well as increased investment in technology to expand to related businesses and better serve its customers. Hence, the full year results should give a better reflection of the company's business than its quarterly figures. So for the full fiscal year of 2021, revenue grew 76% to $937.8 million, net income grew 61% to $131 million, and adjusted EBITDA increased 48% to $228 million. As for its lower than expected guidance for next year, fiscal year of 2022, management attributes it to being more conservative in association with the risk of lower retention, which the company referred to as persistency. These adjustments in guidance are part of managing a growing business. It will be difficult to estimate accurately in the short term, with so many uncertainties and risks in growing the Insurtech business. But overall, the company is still well positioned to experience the tailwind of consumers turning to online solutions for their insurance needs. Well, it's clear that SelectQuote has been growing very fast over the past few years. The company's revenue grew at a compounded annual growth rate of 67% from 2019 to 2021. In fact, the company has been able to show GAAP earnings or net income over the past few years as well, growing at an impressive 61% year-on-year from 2020 to 2021. However, I want to point out here that the company recognizes both the upfront commission and the estimated value of renewal commissions as revenue in the period in which the policy is approved. This means that a good portion of revenue recognized for the fiscal year will stay in its commissions receivable account and will only be paid to the company in cash in the years to come. So while SelectQuote has been reporting positive net income in recent years, it has been burning a substantial amount of cash to run and grow its business. The cash used has come largely from the business itself, proceeds from its IPO worth about $340 million, and a cumulative debt currently standing at about $460 million. Therefore, it is important to understand the economics or the rate of return on the cash spent on marketing upfront. In the chart here, the company illustrated its cash flow projection of its 2021's cohort who signed the insurance policies during the fiscal year. You can observe that it takes about 2 years for the company to break even on the upfront cost spent in acquiring the customers. Following on, the subsequent years will add to the cash profit for the company. Overall, the company expects more than 20% internal rate of return for the fiscal year 2021's cohort. As a matter of fact, those earlier cohorts of 2019 and before have already broken even. In addition, each of these earlier cohorts are expected to deliver in excess of 20% internal rate of return, with 2015 and 2016 cohorts already achieving such returns. The reason for sharing with you all this is to have a better understanding of SelectQuote's financials. Although the company is registering positive GAAP earnings, it is running on negative cash flow. On the other hand, based on the company's cash flow and internal rate of return projection, it implies that the business is profitable. Future cash flow should be able to more than compensate the upfront marketing costs to acquire customers and translate to profits for shareholders. Moving on to valuation. At the current share price of around $13 a share, or a market cap of around $2.13 billion, and a net income of $131 million for the fiscal year of 2021, its trailing price to earnings ratio will work out to be about 16.5. In fact, the company is well positioned to experience the tailwind of the Insurtech market, projected to grow at a compounded annual growth rate of 34.4% from 2021 to 2027. And this is in line with analyst estimates of SelectQuote's revenue to continue growing at more than 20% from now to 2025. Therefore, I think it's quite a good investment opportunity even now to buy into a company growing at high double digits in the next few years at a PE ratio of only 16.5. Assume SelectQuote's revenue is able to hit analyst target of $2.57 billion for 2025, and that the company maintained its 2021's net income margin of around 14%, the projected earnings for 2025 will be about $360 million. Now, assume a modest PE ratio of 15 by then, this $360 million earnings will translate to a market cap of $5.4 billion. This means that its share price will more than double from the current price to $33 a share. To sum up, SelectQuote presents an interesting investment opportunity to ride on the wave of the growing Insurtech market. However, there continues to be significant risk that investors need to be aware of. As discussed earlier, the company is still not cash flow positive even though it reported positive GAAP earnings. In order to continue financing the company's growth, management might need to raise more cash from debt or equity offerings. Either way, it will not be good for its share price. Also, if its persistency metric deteriorates, meaning customer retention is poorer than what the management has projected, then it will lower future cash flow projection. Another key risk involves potential change in government policies. For instance, President Biden and Democrats may want to expand government plans, making the need for supplemental insurance obsolete. If that's the case, it will impact SelectQuote's business negatively. Otherwise, I would say that the current share price still looks like a good price for the company growing at high double digits. However, be prepared to ride on the volatility in the short term. Let me know your thoughts on this and share with us in the comments below, and consider subscribing to the channel if you find what I shared with you today is useful. In the meantime, check out the recommended videos here to continue learning so that you can make better decisions. Keep learning, and I'll see you next time.